Hello everyone, welcome back to Chill Dill Trades. Appreciate you coming to the video. If you're here for the first time, I cover everything in the market, going through both the fundamentals and the technicals of specific stocks or how the market's looking in general. If you're here for the second, third, or many times, appreciate you coming back. Please like and subscribe if you like any of the content. And today we will be starting the race to 100 subscribers. Once I get to 100 subscribers, I'll randomly choose one person to go on a FaceTime or a Zoom call with and kind of show you how I go through technicals of a chart and give you some insight to hopefully help you trade better when it comes to technicals. But let's jump into the content. I'm really excited about the stock I'm covering today because I love the company. Unfortunately, the stock has not been looking too hot. And that company is Root, R-O-O-T, or Root Insurance. So if you never heard about the company, it was founded in 2015. It has over 1,000 employees, so it's grown pretty substantially. You know, that's a decent size for a company after 5 years. And they're a car insurance company. Primarily, they also do insurance for your home and a couple other things. But what's interesting about them is they kind of have developed an app that you download on your phone, and you sign up through your phone, and basically how it works is you kind of have this 2 week period where they kind of see how your driving is, essentially, and then they decide who they're going to allow on their platform. So the whole theory behind the company is they only allow safe drivers from whatever their technology reads onto their platform, which brings down the premiums for everybody on the Root Insurance network. Which brings down the cost and makes it potentially a little bit cheaper than some other providers, but still providing the same type of coverage. So it's a really, I think, pretty amazing company. I think they can change the insurance industry, car insurance industry, but it can often be expensive to kind of disrupt an industry that's been around for years and years and years. So the first thing I want to look at is just kind of how Root has been performing, kind of generally speaking. So they went public in, it looks like, when was it? October of last year. And it's very unfortunate because their stock has basically gone down since the IPO. They started around $29. And as of yesterday, which is June 15th, they're just below $11 a share. So they've gone down about 26, 36. They've gone down a lot. They're down 60% since their IPO. And so let's first look at them versus some of their competitors. So I would say there's two main competitors in the market that we want to look at for them. The first one is Lemonade. You've probably heard about them. They've been doing a lot of advertising about their business, and they're somewhat similar to what Root does, but they go more after like home insurance, life insurance, like the other forms outside of auto insurance. And the other one is Metromile. So what Metromile does, if I remember correctly, actually, I think they do they kind of give you insurance for your car based on how much you drive. So you kind of choose how many miles you're going to go in your car, and then they kind of assess how much their insurance is going to cost you based on how much you drive your car. And so when we look at this chart, the main thing is Root's the dark blue line. This has severely underperformed the other names in this space, severely. Lemonade is up almost 40% in the last year. This Metromile is up, or they're down about 5%, but Root is down 60%, so quite a bit more. And so the first thing is really understanding why they're down so much. So let's go ahead and look at their finances. So since they're such a new company, we don't have as much detailed data, but thankfully they have opened up their books a little bit, so we have some understanding about how they've done it as a company. And so let's first go back to the earliest quarter that we have from finance for them. So that's Q4 of 2019. So in Q4, the main thing we see is 106 million revenue. That's the first thing I want to pay attention to. They had about 400 million in cash. So when we go a quarter forward, we see that, year over year, this has grown quite a bit, but quarter over quarter, it's up about 20 million. But they also saw their net income decrease even larger. And this is, I would say, the biggest red flag of why I think this stock is going to have more pain in the short term, is because of how much cash they're burning. And if we go to the third quarter, again, unfortunately, COVID reasons, but their revenue dropped off quite a bit in 2020. As we can see, it went from 124 million a quarter to just 50 million. And obviously during COVID, no one was driving. And where the red flag is, they were still burning as much money. So this is the first reason why I think this stock has sold off so much, is because they have ridiculous cash burn. And until they get this figured out, I think this is going to be the biggest Achilles heel for this company, is without their revenue growing substantially, like even Q1 2021, their revenue has increased a little bit, more during COVID, but it's still not where it was, pre-COVID, at over 100 million a quarter. But we still see their cash burn up above about 100 million a quarter. So they do have some more cash on the balance sheet, which is nice because that's going to help fund all the growth. But what this tells me is having revenue of 68 million, but having a larger cash burn, which basically means you have negative net income, is they're having to pay a lot to acquire a customer. And it makes sense because they're doing something, I think, that hasn't been done quite yet in the auto insurance industry, where it's very app-based. You can also use the web, but it's mostly app-based. You have this kind of 2-week period where they assess if they even want to bring you on the network, where, a lot of other insurance companies pretty much allow almost anybody on their network. But obviously they're just going to pay more. And so I think that's going to be the issue, is their cash burn. We don't know their acquisition cost per customer, but I'm assuming it's really high based off their net income. So this is going to be the issue. And if we see growth maybe go back to where it was in 2020, 150 million a quarter, but we still see this net income grow in terms of how much they're losing, at some point they're going to have to dilute shares more unless they get private funding. So those are a couple red flags. But let's go to something more positive, because that's a lot of negative things. And just to reiterate, I love this company, but I'm not too sure if it's an investment. If it's ready to, if it's the right time to invest in this company. So something I want to bring up that's really interesting is how Root compares to Lemonade and Mile, which is, I think Mile is their ticker, Metro Mile, on a valuation basis. So this is based off Q1 2020 results. So where's it at? Gross written premiums. So they had 201 million compared to Lemonade's 76, which we see Lemonade growing quite a substantially more. And I'm pretty sure, I have to relook at the numbers, but I'm pretty sure Lemonade also has a higher valuation in terms of market cap. Root's around 2.5 billion market cap, and Lemonade's even higher than that. So they have, they're a lot larger currently of a business, and even larger than Metro Mile, or I'll just call it Mile for the sake of being. But we do see better growth for Lemonade, so maybe that's what some people are kind of putting into the valuation of the company, is that they're growing a lot more than Root is. The next thing I want to look at is, here's the market cap actually. I was just talking about it. So market cap for Root is 2.3 billion, but Lemonade is 4.8. So this is the biggest disconnect that I have, is for a company that has so much more gross written premiums in terms of their revenue, their valuation is almost half, if not more than half, of Lemonade. And that just strikes me a little strange. And even on the net debt side, when we look how much debt they even have less debt than Lemonade. And so when I'm kind of comparing these, and this is what a lot of people have done, is compare these two companies, the valuations don't make sense how we're comparing them. The last thing I want to look at here is just their, basically it's showing their multiple based on their valuation. So if we come up here, we can see Root, while an insurtech company, is valued at only 1.7 multiplier, which is about the same as a traditional insurance company, where we see Lemonade as a 12 times multiplier. And so that's, I would say, which is a really big disconnect for me, is that I don't think they're a traditional insurance company. I think their technology is probably being undervalued in terms of their market cap and their potential for growth. I think once COVID kind of ends and things like that. So I think there's a lot of red flags, but there's also some really positives in terms of them being undervalued as a company. The last fundamental aspect I want to look at is how much kind of they've received from institutions. So we see 352 million, but this was at their IPO. I'm pretty sure. Actually, this was before this was in Q1. So this is how the stock was going down. They had a little lift. I think they went from $14 to about $21. I think a lot of institutions bought in as they were about half their IPO price at that time. But as we'll get to the charts in a second, the stock kept going lower. So it's going to be interesting to see what these institutions do over the next few quarters. If they hold on and grow their positions, or if they start selling off of their positions. We do see more buying than selling, even though the prices dipped this low, so that's a good sign. I think it is kind of telling us that some people might not believe in it, but there might be more people who believe it at this price than don't. So that's something really important to keep an eye on. Not so positively, we see that a lot of the investments are pretty small, which I don't typically like to see. When I look for companies to invest in, I really want to see big money getting behind them. So instead of like $1 million investment, I want to see things like 10 million, 20 million, 30 million. And for the most part, what we see is we see people with bigger positions pulling or making their positions smaller, which is not a great sign in my opinion. I want to see things like this, like this bank credit. They did a 33 million investment last month. Those are the kind of things I want to see in giving me more bullishness in the stock long term. So the last thing I want to cover is just the chart, just to kind of see where we're looking technically speaking. So as we can see, they IPO'd, they hit a high of about $30, and ever since then they've just been on this downtrend. And so it's really important to see that they're basically in a trading range. And ironically enough, so right here we see this price, this area right here. So what actually happened here is Root was actually like one of the top shorted stocks. So when we had the meme stocks being pushed higher because they were shorted, the same thing was happening with this stock. It got squeezed higher from about $8 to 14, and now it's on the way down. So we've kept this trading range until the story changes there, until we break out to the upside. This is still looking like it's in a downward trend. And if I give my personal opinion, I think this stock is headed lower. And the only reason I say that is I think we're soon going to get a correction in a lot of the tech names, and this is insurance tech companies, so I think they're going to feel the pain as well. And there's not quite as much institutional investing at this price. In my mind, if IPO fell from $30, down to $8, I would hope to see in a company that's so well regarded with some really good foundational investors, both pre-IPO and at the IPO. You would think that they would be adding more if they had a really big conviction, as the stock is down 60%. Until I start seeing a lot more buying from institutions, it's telling me that this is not yet a long-term investment. I think based on their cash burn, until they can pull their cash burn down or grow their revenue at a rate much larger than their cash burn is, or their negative net income, I think we're going to continue to see downside. If I just kind of draw out a scenario here, where we at July, I could definitely see it kind of doing this. And I definitely see it, I'm saying somewhere between the $4 and $6 range is probably going to be my buy. It's not financial advice, but I'm looking for somewhere between the $4 $6 range. I think once it gets down to that price, it's more of like a psychological thing where people are like, this is only a $4 stock. This is only a $5 stock. I think people are going to start considering, like, the psychology of the investors and be like, that's too cheap, even though their valuation is still going to be about $1.5 billion market cap. So that's just an overview of Root Insurance. Again, I love this company, but I think they do have some more downside in the near future. And until they get somewhere to that $4 and $6 range, I'm probably not going to be buying in to the stock. And just to recap, the technicals aren't showing anything promising right now, and the fundamentals are showing a lot of red flags. I would say more red flags than positives. So, but I definitely think this is a stock you want to keep your eye on. I definitely think it's a long-term investment, but once it gets to a little bit lower price range, it's something to start accumulating shares in and building your really long-term portfolio. So I hope you like the content. Great company, maybe not the price yet. Please like and subscribe if you like the content, and help me get to 100 subscribers because I'll be doing a giveaway. Thanks so much, guys.